Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based out of our Manchester office, and this week I'm pleased to be joined by regular commentator and head of fixed interest research, Richard Carter, and Ben Barringer, one of our global equity research analysts covering the tech sector. Very good morning to you both. To set the scene, a quick recap of what went on last week. We had a 2-week ceasefire announced between the US and Iran, alongside that, don't know if we can call it a reopening, but the reopening of the Strait of Hormuz and peace talks. Markets took the good news and ran with it. So equity markets surging, bonds rallying on the hopes of a resolution of some sort to the conflict. However, as the week went on, the ceasefire appeared more and more fragile, with both sides accusing each other of violating the terms of any agreement. The peace talks that did take place over the weekend in Islamabad, led by the Vice President and Steve Witkoff and Jared Kushner, didn't really yield any results whatsoever by the sounds of it. Both parties seem quite far away from the terms that both view as acceptable to end any hostilities. President Trump then late on Sunday night announced a naval blockade of the Strait, specifically targeting Iranian vessels, and then interestingly, China has come out this morning to call for unimpeded access to the waterway. So I guess watch this space. Clearly, we'll probably have further peace talks as well in the coming days or weeks. Linked into that, we've begun to see the impact of the closure of the Strait and inflation figures. So we had US CPI out last week, which we'll talk to Richard about shortly, plus a further downward revision to the Q4 GDP reading. And finally, closer to home, in Hungary, we had, I think, a very significant election victory where Viktor Orban was defeated by Peter Magyar, despite a late visit from JD Vance. So Orban, who has been in power since 2010, effectively taken over complete control of the country, the institutions, changed the constitution, the electoral system, and frustrated the EU and sided with Putin on many things. So a huge opportunity there for Hungary, I think, given the expected 2/3 majority, which is needed to row back a lot of those changes made by Orban over the years. So, Richard, first of all, if you could try and walk us through the reaction to the announcement of the ceasefire that we had in the middle of last week. There were some quite sizable moves in bond yields. Have they remained at those levels? What's the picture with inflation expectations, interest rate pricing, etc.?
Yeah, I mean, it's hard to keep up with the latest developments on all this. It's changing so rapidly. I mean, there was a big sort of relief rally on the back of the ceasefire announcement, because obviously, if we remember going into that, it looked like, Trump was preparing to step up the bombing campaign. Unfortunately, he decided to do another one of his tacos, and the ceasefire was announced. But unfortunately, it quickly became clear that the two sides are a long way off, putting a sort of longer term agreement in place. You also had the issues around Israel and its campaign in Lebanon, which upset the Iranians. And these latest peace talks haven't really, like you say, yielded many results. Particularly the nuclear issue is still there and still needs to be resolved. So Trump, with his blockade of a blockade, or whatever you want to call it, he's trying to extract himself from this mess that he's got himself into, and finding it very, very difficult. So the rally in sort of bond yields was fairly brief. Inflation expectations remain pretty elevated, and you're gradually seeing forecasters revise up their estimates for inflation this year, and also interest rate expectations are very different from what they were a few months ago. Bank of England is expected to hike a couple of times this year, as is the ECB, although the Fed is likely to be on hold. But these things are moving around, minute by minute, depending on the latest comment from Trump.
Yeah, just sticking with that, I guess, as I mentioned before, we had the March CPI print for the US the end of last week, showed that prices rose at 3.3% year over year, so slightly below the forecast, 3.4. but quite concerning the components in there, I guess. So petrol prices, or gasoline if you're American, up over 20% on the month. So that, I think, is the biggest monthly rise since 1967. And that's something that's closely watched in the US, and seems to have fed through to the consumer confidence data as well we had out. What impact will that have, do you think, on things like consumer behavior? Does it risk feeding into growth to choke off demand? And what does it mean for the midterms as well? Because I know the gasoline price is always kind of forefront of everybody's minds, and clearly Trump will have an eye on those at this stage.
Yeah, he certainly will, which is why I think he's rapidly trying to work out a way to get out of the whole mess. I mean, I think the market reaction in general so far, certainly in the bond market, has been primarily focused on the inflation impact. But as time goes on, as the Straits of Hormuz remain closed, the impact on growth is going to be worse. Yeah, like you say, we saw that, with the sort of consumer confidence numbers being pretty soft, and gradually we'll start to see, I would expect, things like travel. That will be under pressure, and ultimately retail sales will start to soften if people have to spend more money on gasoline and all the rest of it. So it is a concern. I mean, the Fed has obviously got unlike the Bank of England, has got a dual mandate. It's got to focus both on inflation and employment. So far, unemployment numbers, labour market's pretty solid. But longer this goes on, the more that could change. So Trump has already lost the support of some of his base, I think it's fair to say. Some of these podcasters and talk show hosts and all the rest of it seem to be pretty much against what's going on. And it's just a question of how he can extricate himself from the situation he's in.
Yeah, let's see how he does that. And just last one for you, Richard, quickly on Chinese producer price inflation. So for March, we finally saw China move out of deflation, recording its first year-on-year increase of 0.5% in March. What do you think that means? Can we read too much into that, or is it all energy driven? Because it has been kind of that very extended period where prices have been in deflation and the impact that can have on the economy.
Yeah, that's right, Jack. So China's obviously been in this sort of deflationary trap for some time, bit like Japan was for a period of time. Sort of too much, debt, there's excess of supply, and really a sort of lack of demand. And those producer price inflation numbers have been negative for some time. Often it's actually driven by what happens with the pork prices, but they did turn positive last month due to the rise in energy and the price of oil because of the back of the war. I mean, if the war is over pretty quickly, then this is probably going to be sort of fairly short-lived, and a sort of deflationary impulse will remain. But clearly, if we see energy prices remain elevated, then it could have a bit of an impact. But I think ultimately that's not going to be particularly good news. What they need is for demand to improve, and possibly we'll see some sort of stimulus out of the government to help that happen.
That's great, Richard. Yeah, watch this space. Thank you for that. Ben, turning to you now. Thanks for joining us this week. Always great to get your thoughts on tech. If we start with maybe a more broad question, how you're viewing tech at the moment. There's a lot of press coverage around the whole AI disruption, particularly affecting software companies. And there were some further falls, I think, at the end of last week on Anthropic's latest Claude Mythos model. So how are you viewing tech in general at the moment?
Yeah, thanks, Jack. It's very divergent, actually. The things that we really look at are semiconductors, the chips, and the sort of hardware that people sell, and then software as well. And the divergence couldn't be greater at the moment. Semiconductors, quickly, if you look back in 2023, semis was hardly growing, and as we've seen capex from the large hyperscalers leading to data center builds and therefore filling those data centers with chips, the demand for AI semis has accelerated through 25 into 26. And we're currently expecting sort of 40% growth in AI semiconductors. And that's really, memory, processors, power. And the other thing that's important is, as there's demand for those chips, it also means, more chips need to be made. So the equipment that makes the semiconductors, semicap equipment, is also growing very strongly. We'll see strong growth in 26, 27. I'll touch on that with ASML a little bit later. But then the other side of the coin is software. And software similarly had a very good COVID period, 21, 22, but then has seen demand and growth gradually start to ebb away. And that's partly macro, that's partly slightly constrained IT budgets. But the main thing the market is worried about is disruption of traditional software. And, we think this is a genuine threat to quite a lot of businesses in software. We're moving with AI, if I just take a little step back, from a sort of information age from the internet to much more of a cognitive age. And we're moving to a new sort of compute platform, think PC, think internet, think smartphone, think cloud computing, think AI. And that's having a number of impacts across the economy. It's radically reducing the cost of intelligence. It's radically increasing the speed to knowledge. You use ChatGPT and from question to action, and traditional information friction, I think, is a nice way of thinking about it. Those barriers are coming down, and that's meaning quite a lot of businesses are going to be impacted by the fact that information and knowledge is that much easier for consumers and enterprises to get a hold of. Now, and then also it's quite hard to pick winners at the moment, because if you look at Anthropic, and you look at OpenAI, and you look at Google Gemini, and you look at Meta, there's a constant leapfrogging of model development that's happening. And the thing that's interesting, I think important for listeners to realize, is that if they used AI a year ago or 2 years ago, that AI has got a lot better. It is making less mistakes, and its scores in terms of its intelligence, IQ, are continuing to go up. And so that's very disruptive for lots of businesses in the information area and also in software. Now, where we are in terms of the way we're positioned, we try and be in the more defensive area of software, but that hasn't been much of a relief, to be honest, because the market is taking a sort of shoot first and ask questions later approach to this. And there will be businesses that companies can't, it's too sticky, they can't remove from their sort of supply chain. There will be others where they decide that they can either adapt existing systems or come up with their own systems and use these AI models to do some of the coding themselves. So it's called vibe coding or self-coding. So that is very disruptive, and it's continuing to mean that software is underperforming. So very much a tale of two cities, Jack, in terms of tech at the moment. Overall, we're in line, but we like semis. We also like internet as well.
That's really helpful, Ben. Kind of set the scene of how we're viewing tech, because you can't buy everything. Sticking with tech, how has Mag 6, if you exclude Tesla, how's that kind of cohort fared during the recent turmoil? What do valuations look like, and earnings growth within tech maybe versus the broader market?
Yeah, that's a really great question. So, legitimately, there are concerns about some of these big hyperscale companies, elevated capex, the impact that has on free cash flow, and some, concerns about the return on that invested capital. Now, we're a bit more positive about some of the returns that you're starting to see. You're starting to see it from Google and Meta, very good returns actually on those investments. But the market, is partly skeptical. Also, in the recent, turmoil in the Middle East, tech has very much been used as a sort of funding short, or a source of funds to fund, energy exposure. And then the other thing that's important, we'll talk about this in a tick, is there are some very big IPOs coming up. It's going to be probably $3 trillion worth of IPOs over the next 12 months. And Mag 7 is one of the areas where it's liquid, and you sort of, if you will, take some money off the table in anticipation of those IPOs. But in terms of, to answer your question directly on sort of Mag 6, Mag 7, we're actually it's derated quite significantly. So, a year ago, 18 months ago, the Mag 7 traded on 32 times earnings, and today we're more like sort of low 20s, 23, 24, and that's actually for earnings growth that's accelerated over that period. So back 18 months ago it was sort of 17%, and now it's probably more like 24%. So there's not an earnings problem, but there is a multiple problem. But that's an opportunity as we see it, good opportunities we think within the Mag 6, Mag 7. So and if you look at a long-term chart versus the S&P, Mag 6 is actually as cheap as it's been over the last 10 years versus the S&P. So we think that's reasonably constructive for certainly that mega cap area.
Yeah, I completely agree. We'll get an insight into how tech has been performing. So we've got TSMC, ASML, and Netflix reporting later on this week. What are your thoughts going into the results for those companies? Year to date, they've actually done fairly well. Granted, Netflix had a difficult period towards the end of last year. But what are your thoughts on those three?
Yeah, let's take TSMC first. So they've already reported actually their monthly numbers. So we've had January, February, March sales numbers for TSMC. So we've effectively had the sales number for the quarter Q1, and it came in at 35% growth versus their guide of 30%. So, doing really well. And there's a good reason for this, and that's driven by AI semiconductors that I talked about earlier. If you don't know who's going to win the race between NVIDIA and AMD and Broadcom and all the different chips that are being produced, the best each way bet is TSMC, because largely they make the chips for all of those companies. In fact, they don't make, the only people they don't really make chips for are Intel and Samsung, and in some cases they do make chips for Intel. So yeah, they're very much a one-stop shop for that sort of chip exposure, and not particularly expensive. So we really like TSMC. The other thing that's really important for that for TSMC is their capex number, because it indicates their sort of their confidence in the future. And remember that last quarter they increased their capex, so it's now going to grow 32% this year, and they also made comments that it'll continue to grow into 27 and into 28, and that's really good for the companies that make the machines that make semiconductors. And that cascades onto the second result I wanted to talk about, which is ASML. They report on Wednesday. And there are three things we really have to think about with ASML. The first one is what's happening in logic, i.e. processors. So their biggest customer is TSMC, but Intel and Samsung have also got plans to grow their capex. So that's pretty positive. Second is the memory area. So companies like Samsung in memory, Hynix in Korea, and also Micron, the three biggest players in memory, certainly in the DRAM side. And so there's good growth there, because all of these big data centers not only need processors, they also need memory for their AI systems. So memory continues to be quite strong. The third swing factor though, is China. All ASML and others are guiding China down actually this year. Indications are that actual physical demand from China, because they're building their own semiconductor manufacturing industry, it looks very strong, but there are further restrictions coming through the House and Senate that could further restrict. So it's a big sort of variable for them. But as I say, the overall outlook for ASML pretty positive. We expect good accelerating growth in 26, and then a further acceleration in 27. So that one looks pretty well set up. And then finally, just to complete the piece, is Netflix. As you alluded to, they've had a fairly roller coaster year in terms of the share price. When they started bidding for Warner Brothers Discovery, they have since pulled out of that bidding race, and so can, if you will, get back to the knitting that they're so good at. Growing subscribers, creating really good content for those subscribers, and that giving them a pricing umbrella to continue to grow their sales line. So still expecting mid-teens growth from Netflix. And the interesting thing about Netflix compared to some other tech companies is there's not much cyclicality in the Netflix business. So it's very much a defensive growth area. TV is a pretty defensive asset. Nobody really turns off their their Netflix subscription if things are tight. It's actually quite a cheap form of entertainment. So there you go. There's 3 we're expecting this week, and then obviously over the next 2 or 3 weeks we'll get some of the larger mega cap names reporting.
Great, thanks, Ben. Yeah, 3 names we really like, so it'll be interesting to see how that pans out. Finally, you did mention it, so we've got some really quite exciting IPOs that could take place this year. So SpaceX, Anthropic, OpenAI. Are those likely to come to fruition in your view, and do they need to for their own viability?
Yeah, it's a good question. I think it would be certainly do they need to? In some cases, yes, they do, just to continue their capex plans. I think the first one out the gate is probably going to be SpaceX, and it's probably the biggest of them actually by my maths. They are expected to IPO at around 1.2 billion, maybe 1.5 billion. Again, this is a sort of amalgam of lots of different assets from Elon Musk. Obviously, there's the rocket launchers. There is the telecommunications service, satellite service, Starlink, and then there's also sort of XAI in there as well. So it's going to be an interesting model business to value. Then you've got OpenAI. Numbers for OpenAI continue to go up. They're currently run rating about 25 billion per annum of annualized revenues. That's needed to produce, to help the capex for their own data center rollout. And then, their sort of cousin, if you will, is Anthropic, the makers of the Claude AI agent, and they are actually growing even faster. So they started a bit slower in terms of their revenues, but they're now currently running at 30 billion. So Anthropic and OpenAI it's going to be an interesting war of words between, those two. And then we've also got some other businesses potentially on the block. So a company called Databricks, which is in the sort of data side of the estate. And we've got Stripe in payments potentially coming too. Now, from my perspective, I try to understand these businesses pre-IPO. So because the IPO process, if you don't know it, is pretty short. You get like 2 weeks to sort of process a load of information, meet the company, read a load of stuff, and then decide whether you're in or you're out. I much prefer to meet companies over a much longer period to really try and assess their sort of, all the things we try and look at, their moat, their competitive position, their financials, and all the different moving parts that are, what it's going to mean when they do eventually come to market. So, yeah, look, it's going to be a bit busy time for me and the team over the summer, but it would be a very good test of this market. We shall see. It's a very volatile market at the moment, obviously not helped by things in the Middle East, but if we can get a few of these away, it should help to maybe calm things down a little bit. We shall see. That's not a forecast though. I think there is, but it's interesting that these businesses are looking to come to market.
Absolutely, yeah, like you say, potentially a very busy summer for you with all those under your coverage, probably. So thank you, Ben, and thanks to Richard and to all of you for listening. So did you enjoy our discussion on the podcast today? We do love to hear from our listeners, so please review the show now wherever you're listening, share it on your socials, and tag us at Quilter Cheviot. And to make sure you don't miss a future episode, make sure you tap the subscribe button. We'll be back next week. In the meantime, you can head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. And you can stay up to date as well on our thoughts, market news, industry insights, and any upcoming events and webinars on our website or on our social media pages. And then finally, we do like to hear from our listeners as well. So if you've got a question that you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on the website. And that's it today. So thanks, Richard. Thanks, Ben, for your time, and to all of you for listening. We'll see you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.